Hello, in this lecture we're going to talk about a special project or special offer and discuss the decision as to whether to accept or reject it. We will be able to, at the end of this, explain what a special offer is and give a method to analyze the decision to accept or reject the special offer. So the example that is best to get the concept down would be to look at if we were operating a hotel. So this is our nice hotel on the left-hand side. We charge $300 per room for the hotel. And the way we came up with that $300 sales price is that we said, well, there's $250 in cost that we are assuming here, or we are calculating through, and we're saying that 100 of that is variable for maintenance on the room, and we're going to say that the fixed costs are 150, and that's of course basically could be like the depreciation of the building. Much of the building is going to be part of the cost, just the cost of the building. So the variable cost being kind of like the maintenance per room to fix the room after each night, and the fixed cost being the cost of the building. So we have this vacant room here at this particular night. So we have the vacant room. Someone comes in and offers $200 for that room. And of course our normal price is $300. They're offering us $200. And the question is, should we accept or reject this special offer? So that's kind of what a special offer is going to be. It's going to be an offer below the normal price, outside the norm. And normally we would say, well, no, we're not. It's $300, and we're going to say, well, we got to the 300 by saying it costs us $250, so we'd actually lose $50 on that transaction. But if we were to analyze this as just a one-time special offer, we'd say, well, really, we might want to accept it because really we're only going to have to account for the $100 of variable costs. So if they gave us the $200. We really only have to pay for the maintenance of the room of the $100, and therefore we really basically have a $100 increase in profit, because this fixed cost that went into our calculation of the total cost is still going to be there. We're going to have to pay for the building. We're going to have to pay if we have the loan on the building and the depreciation related to the building. Those things are still going to be there, and if we don't make the sale and we have the vacant room, we're still going to have those fixed costs. So if we did not sell the room, we could eliminate these costs, the 100, the variable, but we couldn't eliminate the fixed costs. And that's gonna. So in terms of decision making, the relevant cost then would be the variable costs, and that would be what we would assume in our calculation. We would get the 200 that we would not otherwise get if we didn't make the sale because it's a vacant, and then if we would subtract from that, the relevant cost would be the variable costs here. Now there are some other things to consider here. One is that, well, if we negotiate, could we get the $300 or increase the price? So we want to consider that, of course. And the other is that we don't want to alienate any good customers. I mean, if these other 3 rooms are occupied by people that are loyal customers and they realize that we are making special offers for people at lower prices, and that really kind of works in reverse to the current customers, because the normal thought process would be that better customers, people that are return customers, should get the discounts and whatnot. So we don't want any of those special offers to affect our relationship with the current customers. So those are things to consider as we go through this. We're going to look at a bit more complex analysis, same type of thing, bit more complex analysis. We have the 200,000 units that we are going to produce under normal conditions at a sales price of $3.87. These are going to be our estimated total costs here, some variable, some fixed. And then we have a special offer. So someone comes in and they're going to say, well, we'll purchase 33,000 units if you give us a special price of $3.49. Now this is significant to us. We only produce 200,000, so this is a big production, big job for us. So the question is, should we accept or reject that? If we accept it, we believe that we're going to have to do some overtime. So the rate for our hours are going to go up a bit to pay for the overtime, and then the variable portion of the overhead is 75%. We also think that we're going to have to pay $4,000 more for the admin. So we're going to do the same type of analysis. We're going to say, okay, which costs are relevant to this decision, which cost is not relevant to this decision. Many of the costs that will not be relevant to the decision will be the fixed costs. And remember that the fixed costs are usually incorporated in us coming up with this sales price. That's why that change in the way the cost behavior works is why this decision can become wrong a lot of time. We can calculate this type of decision based on the fact that the fixed costs are in our cost analysis. So let's take a look at this. We're going to say the sales here, our sales per unit, are going to be the 387, And the special project, they said that the sales were going to be $349 per unit. So if we took the without the project, our normal revenue then would be the $774,000. That's going to be the $387 times $200,000 that we normally sell. The special project's going to provide the $3.49 per unit times the 33,000 more units we will produce at that special price. If we add those two up, then we have a combined revenue of the $889,170. Then we're going to look at the variable costs. So we're going to break out these total costs between the variable portions. We're going to figure out what the variable cost per unit would be, and then apply those variable costs per unit to this 33,000 and see what those difference would be. Now these are going to be the relevant costs, the variable costs, because those are the ones that change with production. Those are the ones that if we don't accept the offer, we can avoid. If we accept the offer, we will incur. So we're going to say the direct materials, we're taking this 256,000 divided by 200,000 units. Because they change with the level of production, we get the 128. So 128 per unit. That's going to be the same for the new offer. So we're going to make 33,000 more units. It's still going to cost us 128. So our total cost is going to include our normal cost, which was the same, this 256, or the 128 times 200 units. And then we're going to have the new cost, the 128 times the 33,000 units. That's going to give us this 42,240. So then our total cost for direct materials then would be the 289,240 increased by this 42,240. That's a relevant cost to our decision making. And then we have the direct labor. Similar analysis. We're going to say, all right, we got 62,000 of total. We produced 200,000 of them. It's a variable cost. Therefore, if we divide that out, the 64,000 divided by 200,000, we get the 32 cents. And now we're going to say that that's changed because of overtime. We said it's going to go up by 50%. A couple ways we can calculate that. Times the 0.5, and that's going to equal the 16 that we need to add to it, 0.16, plus the 0.32, and that's going to give us the 48 here. Or we could do that a bit quicker by saying it's the 0.32 times time and a half, which is 100% or 1.5, 150%, 1.5, and that'll jump us right to the 0.48. So that's going to be that analysis there. Then we're going to say without the project, that's what we have normally. That's the 64,000, could be calculated as the 0.32 times the 200,000. And then we have the 0.48 times the 33,000 to give us the 15,840, the relevant cost to the decision, the one that we would incur if we accept the new project, giving us a total of the 64,000, the 15,840 of 79,840. All right, variable overhead. So we said that variable overhead. Now, overhead's that thing that's mixed oftentimes. It's got a variable portion and a fixed portion. So of the 192,000, we are saying that 75% of it is variable. So we're going to say times 0.75. So that's going to be the 144,000. And if we divide that variable portion divided by the 200,000, that's how we're going to get the variable portion of the overhead, 0.72 per unit. That's going to be the same for the special project. Therefore, without the project, we have that 144, the 0.72 times the 200,000. With the project, we're going to have the 33,000 new units times that variable portion, 0.74, giving the 23,760. So we got the 144,000 plus the 23,760, giving us a total of 167,760. That's going to give us the total variable costs. If we add these up, we're adding these up here, 232. We got this for the special, it's slightly different because of that increase in the direct labor for 248. And then if we add up the special project here, we could add this up this way, like this, or we could multiply out. We could take the 232. This is we're calculating the normal costs here for variable cost, total variable cost, 232 times the 200,000. And we could do the same thing here. We can add these up here to get the 81,840, or we could take the 248 times the 33,000, and then we get the total. The total could be added up this way, the total costs, or they could be added up this plus this for the 545,840. Next, we get the contribution margin. Very important contribution margin. in this type of analysis, that's going to be the sales less the variable cost. We got the contribution margin per unit of the sales less the variable cost of 155 for the special project. It's the 349 sales per unit less the variable cost per unit, $1.01. For the total contribution margin, we're going to take the total sales less the variable cost, 310,000, and then we're going to take the special 115, 170 less the variable portion, and then if we added these two up, we would get the combined total here. We could take the total sales here less the variable portion there. So these are going to be mainly the relevant costs, the ones that would not be here in terms of the special project here if we didn't take on the special project. Now, we're going to look at the fixed portion. These are the ones that are not often relevant because there's the ones that are still going to have to be paid, and even if we accept the project or do not accept the project. For example, the overhead. We've got the overhead. We're not going to take it out per unit here because the overhead is something that is fixed. It's not going to change with the level of production. So we're going to say, all right, without the project, we'd be paying the 48,000 units. And how did we get that? We took the overhead of 192,000 times the 0.25, because the 75 is variable. That means 100 minus the 75 is 0.25 is not variable, that's fixed. And that's the 48,000 here. So we have 48,000 fixed. That's not going to change. Now, I'm not going to add it to the special project because there's no relevant cost to the special project. It's still there. So whether we take the special project or not, we're paying the 48,000. So the total cost is 48,000 either way we go. That's the point. So now we got the selling expense. The selling expense was the 80,000, and it's going to be fixed as well. So we're going to say 80,000 is 80,000. There's going to be no added cost if we take on the special project. Still 80,000 no matter what. And then we've got the admin, and that was the 53,000, and again it's fixed, so it's not going to go away, but we said that we had another 4,000 of the admin that's going to be tacked on if we take on the project. So that's going to give us the 53 plus the 4 for the 57,000. That totals up for fixed costs of the 181 and then the 4, giving us the 185. That could be calculated as a 181,000 plus the 4,000, or it could be the 48,000 plus the 80,000 plus the 57,000 to give us the 181,000. That'll give us the operating income, and I'm going to get to the total operating income, would be this 343,330 contribution margin less the fixed cost of 185,000, giving the operating income of 158,330. And that is going to be an increase. This is where we were at without the special offer. We're increasing if we're just calculating based on the relevant costs by the 29,330. Therefore, it's an increase, and yes, we should accept the project. Now, from a book problem standpoint, I just want to point out that probably a lot of these are going to come to the conclusion that you should accept the project even when it looks like you should not, because that's kind of the point of the assignment. But in real life, it could go either way, but just realize that obviously if you're working an assignment problem, probably it's going to look like, it's not going to be a good deal, and then you're going to say, it looks like it could work.